Next guest believes that U.S. dollar strength has peaked. David Bailin is Chief Investment Officer of Citi Global Wealth Investments, and he joins us for a deeper conversation on that. David, it's nice to see you as always. Talk to us about why the U.S. dollar performance is important when you're trying to think about stock market performance.
Let's start with what we said 10 years ago, right? We were in a period when the dollar was doing poorly, right? It was, valued, much less than a basket of currencies. And for the last decade, the dollar has benefited by, basically low inflation in the United States, ultimately low interest rates in the U.S., and an extraordinary, run in technology that led to incredible inflows into the stock market here in the U.S. The stock market in the U.S. at its peak is 63% of world equity market capitalization, which is pretty extraordinary. And part of that, right, is the dollar itself. The reason we think we're at a turning point here where the dollar will actually lose power over the course of the next several years, and probably for the next 5 to 10, is because we've reached sort of peak valuation. And by that, I mean, we're now going to see, the relative value of the dollar, the relative value of our economy fade somewhat, right? That leadership will go down, in part because of capital flows, in part because of the fact that interest rates here are higher and are going to actually peak relatively soon. And because foreign central banks are going to keep their rates constant, even as the U.S. brings theirs down. So all of this suggests to us that one of the things investors can do is to actually move some of their assets away from dollar assets and into non-U.S. Assets and stocks and bonds over the course of the next 6 to 12 months, and then we'll have benefits for many years to come.
Okay, so that's interesting. I know most of the currency conversation is centered around, interest rates, as you alluded to, but we talk a little bit less about the other point you made, which is money flows, and the money flows into the stock market. If you're advising investors to look to other spots to invest right now globally, what are the kinds of areas that you're recommending?
Well, let's sort of set the context for the answer to your question, right, which is, there have only been 3 times since 1935, of which this is one, when non-U.S. stocks have been as cheap as they are, right? They're that level of discount to the U.S. So when we think about it, right, we can do it from a broad indices standpoint, or we can look at specific regions. The number one region that benefits when the dollar weakens is Asia, both China, Pan-Asia, and Japan. So if you had to pick one area of the world, that would be the one that we would actually choose. And one of the reasons we would choose some other markets like Brazil and India is because as China reopens, these are markets that will benefit pretty directly from China's excess growth. And lastly, if you think about the U.S. economy, right now we've got negative money supply and high interest rates. China has an abundance of employment and no inflation. These are the types of things you want to have in portfolio at the same time in order to create a greater risk-adjusted rate of return.
So helpful context there, and there's been a lot of discussion around China this year, certainly a conversation around Japan as well, with Warren Buffett betting on some equities in that market. But just getting back to the U.S. itself, because we highlighted that we've now technically seen the bull market after that 20% plus run off the lows for the S&P 500. We're going to talk a little bit more later in the program about whether or not money has to come out of that tech sector to move into other sectors. But even this morning, we're continuing to hear, positive headlines on companies like Tesla. Even though these companies have become quite costly, could it prove costly to portfolio performance to move away from some of the hottest names in tech?
So a bunch of different ideas, built into your thesis. Number one is we don't believe in market timing. And what you're really suggesting is, when should I get in? When should I get out? The answer is this year has proven that what you want to do with your portfolio is to stay fully invested. The indices themselves, of course, have rotation. If you take a look at the S&P 400 or the S&P 600, profitable mid-cap and small companies, those have risen 7% in the last month. Who would have thought that would have happened right now? One of your prior guests talked about whether or not we're in a recession or not. We actually are in a rolling recession. Parts of our economy are actually slowing. Our industrial area, manufacturing, parts of our economies are growing. Actually, it's been very interesting to watch the revenue growth of technology companies has been far better than expected. Companies that have profitability are growing faster than companies that need cash and need credit. So you can go into the markets and identify areas of excess growth, and that explains a lot of why markets have sort of bifurcated this year, and some have done very well. Now, to answer your question very directly, right? You don't want to actually think about indices, without looking at what's driven them up. What's driven up the S&P are 10 stocks this year. There are 490 more to go, right? And as some of those stocks begin to do well, as we see growth return to the mid and small cap stocks, I think you have the possibility of good growth ahead, with one major headwind that I think we have to take a look at, which is right now, the Federal Reserve and the Treasury are going to issue $1.4 trillion worth of notes and bonds. That is going to take money out of money funds, out of markets. It is going to attract a lot of attention. That's taking place over the next 2 to 3 months. So the idea of it's just a straight upward line and that we're in a recovery, I think, is something that we have to be cautious about.